Okay, so like I said, this week we're presenting our first live webinar series. Today, I'm going to provide a brief snippet from that webinar where we give you 7 to 8 stocks in that segment to buy today while they're on sale. I won't be showing you those 7 to 8 stocks. That's exclusive to the webinar or our clients. Now, with the significant downturn in the markets have produced and are facing, the markets are facing a trade war right now. We define corrections today and bear markets generally, and whether the valuations suggest we are facing a correction or bear, and what to focus on in your portfolio. So, what is a correction? In the stock market, a correction is a significant drop in the price of a stock, asset, or entire market, generally defined as a decline of at least 10% from a recent peak, but less than 20%. So, a bear market, that is simply defined as a decline of 20% or more. That is considered a bear market, a more severe downturn than a correction. Now, these are traditional definitions and we're going to stick with them today. But in recent years, markets have been subject to higher volatility than historical norms. We referenced the flash crash following the onset of the pandemic, which produced a 20% plus decline, but a quick and violent bounce back. So, not a traditional bear market, but a bear by dropping by more than 20%. It was also a great buying opportunity. We may be seeing an opportunity today, albeit maybe a more drawn out opportunity presenting itself. Now, in a number of markets, we have and are already entered into correction territory, and one we've entered into, one maybe two, a bear market. In this table, we can see each of these markets: the NASDAQ, the S&P 500, Toronto, and I included Bitcoin as well. We are definitely in a correction. The tech-heavy NASDAQ has entered bear territory, driven by the negative move in the Mag 7. And the S&P is close to bear territory, also driven by the outsized influence of Apple, Alphabet, Amazon, Meta, Microsoft, Nvidia, and Tesla. And the TSX just moved into red in terms of correction. Commodities have helped prop up that market a bit, but now they're fading as well. Bitcoin, by strict definition, has entered a bear, but with its historic volatility, a 25% move may not indicate a true bear. Now, most of the highs for this group were made in late February. Declines of this magnitude are rare and shocking, and not seen really since the pandemic's initial shock. Of course, all of these index numbers are what we call price-based. To invest successfully, you need to look at the markets from a value perspective because, as Warren Buffett famously said, price is what you pay, but value is what you get. So to determine general market valuations from a historical perspective, one metric we utilize is the Shiller PE. It's a more reasonable market valuation indicator than the regular PE because it eliminates fluctuations of the ratio caused by the variation of profit margins during a business cycle. This chart here shows the Shiller over the last 20 years. The ratio reached its highest point in November of 2021 in the range of 38.6, which is roughly 44.56% above the average PE over the last 20 years, which was 26.7. The November 2021 peak was the highest ratio in the past 20 years and has been eclipsed literally once since it's being tracked. That's over 100 years during the dot-com madness, right there at roughly 44. So your question is, where is the Shiller PE today? Well, today the Shiller PE sits at 31.2. The correction to start 2025 has the ratio decreased from 37.8 in November and is down from 35.5 in April, about 1 year ago, and is now 16.1% higher than the recent 20-year average, which again was 26.7 versus 41.5% in November and 34.7 1 year ago. Now, the recent correction has improved the Shiller PE to a better range than the 38.6% hit in November of 2021. Again, that was 42%, roughly higher than the 20-year average. But it is instructive to point out that the Shiller remains 77% above its all-time average of 17.6, indicating the U.S. markets are not nearly historically cheap. On a more positive note, the regular trailing PE following the correction dropped below its 20-year average this past week to 24.2 currently, recent 20-year average being about 24.9. We have not seen that in some time. Now, near term, we are cautious, but opportunities are developing. So let's take a quick look at the regular PE or trailing PE, which is based on the last 12 months earnings on the S&P 500 over the past 20 years. As we can see here, the US market is no longer close to all-time highs, but not near 20-year in terms of valuations, in terms of 20-year or historic lows. In fact, it remains on a valuation basis around average, despite the significant near-term correction. So what is causing this volatility? Well, at this point, it should go without saying, but the uncertainty surrounding a global trade war, Aaron will detail his thoughts in the next segment, is the big influence near term. The outsized influence of the mega cap 7 adds to the volatility. Their influence has become so great that if they get the sniffles, the market gets a cold. 28% of the entire S&P 500 is these 7 stocks. It causes higher volatility generally. We get to some broad market commentary. Heading into 2025, we saw the markets as historically expensive. The markets have only twice been as expensive as they were to start this year, and thus vulnerable to any significant shock. With that backdrop, it is not surprising to see weakness given the significant uncertainty largely surrounding new, more protectionist period potentially. As I stated, in the near term, the markets hate uncertainty, and a trade war creates uncertainty. We are a bit surprised the markets had not corrected further in some names. We saw more of that movement over the past several days. That is not to say there are not some opportunities out there, but are we, for example, aggressively buying auto parts manufacturers or steel makers? No, at present. There are some select opportunities. Like we said, we see value in today. And because our process is to look at from a fundamental cash flow basis at every stock in Canada and over 8,000 in the US annually, we have a book of names we are monitoring closely at all times, businesses that we really like, but have not yet bought or perhaps want to buy more of that in many cases have been too expensive. We await quality businesses dropping to more attractive ranges. We actually released a new buy on one in the past week, a company that was down almost 50% recently, a good company, now trading in a range we want to buy at under 9 times earnings with growth expected this year and into next. Now, most people believe that you get rich in the boom times. We actually see it differently. You actually make your money in the down markets, positioning yourselves in great businesses that come on sale in sympathy with the market. Now, you realize the fruits of your labor or reap the harvest of that portfolio during a bull surge. But it is the work we do during weaker or uncertain economic times that allows investors to profit in the good times. I'll give you an example. From the silly pandemic highs of late 2021, the entire NASDAQ dropped well over 30% by mid 2022. There were excellent buying opportunities at this time. In the 12 to 18 month period until the fall of 2023, we were able to buy high quality, cash rich businesses at a significant discount to the market. Like this drug manufacturer here, Cipher Pharmaceuticals, CPH, on the TSX in August 2023, it held half its market cap in cash, zero debt. It had growth and low valuations. The stock has jumped from $3.75 to over $12 in 18 months. And it still looks relatively reasonably priced. And in a pullback, it could be an opportunity again. While the current trade war certainly has not produced that type of value, there is a list of companies we are monitoring for similar entry points and long-term opportunities. Essentially, great companies that we can enter in with a margin of safety in terms of the discount to intrinsic or fair value. That will allow that you'll not get these valuations and opportunities in these companies in normal economic conditions. This is both on the small cap end of the market, but also right now we're looking in the larger cap segment. Hopefully, we see many of you in our upcoming webinar and we can go over some of those names. Most importantly, our clients will be receiving timely updates on opportunities in the current sell-off in the coming weeks. All right, that is my segment. And because of the volatility in the markets, it has to constantly be updated right now. It's crazy
Yeah, I had to
how volatile the
exact
markets
same
are.
thing with mine shortly before we started recording, and then I just realized it's out of date again. But it's within a couple percent, so
Hmm.
yeah.
Yeah. No, I mean it's just the volatility. I'm sure it has many people scared in their portfolios right now. But we advise our clients, if you started 6 months ago, you're buying into those positions, you're layering in, starting with 25 to 50% positions, and you're buying that 20 to 25 stock portfolio over a 18 to 24 month period. So now you're buying a significant portion of your portfolio when it has come on sale. And it's there's no perfect way to enter the markets, but even with the uncertainty, it is certainly better valuations that we're seeing today than 30 days ago, than a week ago, but certainly than when we started the year. Now, it may seem more difficult to make those buy decisions when the market is going down, but it is often the most correct decision to make. It's more difficult to hit that buy button when you see markets going down on a daily basis. But if you're looking 3 to 5 years forward, when something comes on sale, even if it goes a little more on sale or significantly more on sale, uh, it is a better time to buy than say 2 months ago when it was 40% higher.
Cool.
Okay. Any comments on that, or should we just
Yeah,
get to
just I mean,
Aaron's
I think
segment
that
here?
just it makes perfect sense. A lot of my
Mhm.
comments really just come down to what
Yeah.
my segment is going to be anyways. But you made a good point. Like there are select opportunities out there where companies with resilient business models are now trading at what we would consider to be very reasonable valuations. But is it really cheap? I mean, there's not blood in the streets yet. And
No, I
maybe there
think
will
that's important to point out. Like, we're just
be.
not seeing that yet. We're not at that point where you've seen a capitulation or anything like that. And maybe you never have that point. Maybe the market's stabilized. The uncertainty is causing this because you don't know if tariffs are here to stay, if some of them are negotiated off, and that makes it a difficult environment in the near term. You have to focus on businesses that you think will be around and grow 3 to 5 years from now, and that's what we're
Yeah.
certainly looking at.
Mhm.
Yeah, and like one thing just to add, because I love Peter Lynch quotes. He says far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So again, it's just with the amount of uncertainty, who knows what will happen here in the near future. So again, buying those quality businesses that are coming on sale now.
Yeah, and you're looking 3 to 5 years out on those businesses.